The chair now recognizes the gentlewoman from Michigan, Ms. Tlaib, for 5 minutes.
Thank you, Mr. Chair. I'd like to focus on the ways that foreign oligarchs can invest in U.S.-based assets to hide or launder illicit funds. And, I know the vast majority, and majority of foreign nationals investing in the U.S. are legitimate. And there's no national concern whatsoever in that regard. But however, we know that there's been an incredibly, easy way to establish anonymous trusts, shell companies in the United States, which has made it easier for sanctioned citizens, and we saw it recently actually, and entities to hide their assets in the United States. I know both the administration, the current one and the previous one, has supported, and I'm sure you're familiar with the Corporate Transparency Act of 2020, which is intended to prevent that kind of abuse of, these shell companies like the one used to hide ownership and control of U.S.-based real estate purchases that are sanctioned by, folks that are Chinese nationals, Russian nationals, a number of folks, again, they're sanctioned. So it's something for the whole witness panel here. How important is it for the U.S. and allied nations to adopt transparency measures like beneficial ownership registries to prevent bad actors from abusing our open financial systems? Because it is really about those resources and the money, as you all know. So I can start with whoever would like to begin. I think, Eric, you had your hand up.
I'm happy to take this one. I appreciate the question. The short answer is it's incredibly important. You've seen even recently in publicly announced actions instances where sanctioned Russian oligarchs, for example, were able to park billions of dollars in trusts that were registered in Delaware for a period of, 5 or 6 years. So the Corporate Transparency Act and the related legislation, were great work done by this Congress, are important steps.
Eric, for my residents, explain why, because this is the danger that I think is not understanding. It's like, oh yeah, they're just moving money for benefit of their own, but it's actually a huge concern because this is how they can fund.
Sure, yeah, exactly. Yeah. So for example, pre-Corporate Transparency Act, an individual could go to a state, form a corporation, and then not be required to submit the natural persons who were the owners or the controllers of that corporation. So in theory, a Russian oligarch could go to a U.S. state, form a corporation in somebody else's name, there would be no verification component, and they could subsequently funnel money through that shell company into U.S. assets, and it may be very, very difficult to detect. That was the issue that the Corporate Transparency Act at a high level was trying to solve. It's being implemented as we speak, so Treasury is rolling out a series of rules to implement it, but that's the sort of core challenge.
Yeah. Anybody else? Mr. Hara?
I agree very much with Eric that the Corporate Transparency Act was a huge first step. Obviously something like that, and Treasury Department is in the process of getting IT and rolling out rules to uncover the beneficial owners of millions of companies. That's a big endeavor, and they need to make sure they have the resources to do it. I do think if Congress wants to continue looking at this issue, and I would encourage Congress to do so, looking at greater transparency around some of the enablers of corporate corporate secrecy, and the lawyers and the accountants. I think that's another good area to push on. And then the other thing I would say,
because there are firms that are actually helping them do it, correct? Yes.
Yes.
Yeah.
The other thing I would say is I think we have to get much more serious about transparency in some of the small tax havens. A few years ago when this Congress was worried about the fact that overseas banks were helping wealthy Americans hide their taxes, there was a very meaningful effort to force banks in Switzerland and the Caymans and places like that to provide tax reporting information to the U.S. There's not really a parallel requirement or serious effort to get, places like the BVI and the Caymans to clean up their corporate ownership structures. And I think it's time to look at what could be done there.
No, thank you. And I just would, for many of my colleagues here, especially my Democratic colleagues, have known that I've spoken about recently, just the impact of seeing somebody like Vincent Chen in our community in Detroit beaten to death after anti-Asian hate rhetoric was increasing during that time, and we're seeing that again. So I just hope this committee, we can do this important work without fueling that rhetoric, being very, I think, thoughtful, so that we can do meaningful work, again, without jeopardizing our Asian neighbors across the country. But with that, I yield.
Now recognize the gentlewoman from Michigan, Ms. Tlaib, for 5 minutes.
Thank you so much, Mr. Chairman. Thank you, Chair Powell, for being here. You have a lot of economic, projections, economic projections, various data, various reports that are coming out. How much, and you've studied inflation, right? I mean, obviously, it's your #1 priority right now. How much is inflation impacted by these three things? Corporate profiteering, egregious executive pay, and the use of stock buybacks.
So I don't have numbers, but I would say in the case of executive pay in the case of share repurchases, I can't think of how it would affect inflation. In the case of executive pay, that would be very small in terms of the broader economy. In terms of profits, though, the way I think about that is profits are high. The places where profits are really high is places where there are shortages and supply chain issues. And as those things get better, as they are, you're going to see inflation come down and even prices come down, and you'll see corporate margins come down there. And that'll be part of how inflation comes down.
So does that corporate profiteering does impact inflation? You don't have any stats of percentage-wise how much of it?
Yeah.
Because you seem, I really paid attention to your testimony in the Senate hearing yesterday, and there was a lot of conversation about, my neighbors and residents' wages and so forth. They're finally starting to see a little bit more closer to possibly getting fair wages. It's not even far enough. But I don't know if the Feds is paying closer attention to monopolies, corporate profiteering, and executive egregious pay. All of it, even the stock buybacks, you're saying all of that aside, you're focused more on wages and increasing the interest rate than on those other
Our focus
major-
is really on price stability, not so much wages. Wages play into that because they're an important cost for business, but they're not. We're not trying to achieve a particular level of wages. We're trying to achieve 2% inflation.
Yeah, and I think it's really important, Chairman, what we saw during the pandemic is, the wealthy and the corporations continued to profit in large scale and still do buybacks and still do really egregious executive pay and benefits and so forth for those at the top. And then, of course, the communities and such were impacted by it. But what I hear consistently is folks thinking that's the reason. All of a sudden wages are skyrocketing, all this. But all I see is continuation, again, of those that are already getting a huge benefit, the folks at the top, the executives and so forth. My friend Glenn taught me this today, that the Feds are actually sitting on, something in Dodd-Frank Section 956. You all are sitting on the last 12 years on guidance regarding executive compensation and the high risks of it. Like around, there was some sort of proposal done, not implemented. Again, it's been 12 years. Why is that something that you're not concerned about regarding inflation?
Well,
like you guys are sitting, one, you're sitting on it, right? Why?
Well,
It's been 12 years. And then two, why is that you're saying that's not big deal? That's not going to impact the cost of products and so forth for our residents?
It's a multi-agency rule, and there have been repeated attempts to get 5 or 6 or 7, however many it is, agencies to agree. That's one thing.
On disclosures?
No, this is on, it's on policies to.
Yeah, which include disclosures and arrangements regarding executive pay and the risk of it.
There. Anyway, 956 is, you're right, we haven't been able to get agreement among the agencies. But more to the point, their boards long since, this is just for the big banks where we have this authority, long since board of directors are very focused on how executive compensation works and that it not reward, unnecessarily risky behavior and that kinds of things.
Yeah, but in Dodd-Frank, which Congress passed, there should, you're supposed to put something in place, and it's not in place. And look, I'm saying this because so many people in this chamber, and I feel like the Feds are more obsessed with wages than they are in regards to the monopolies, the corporate profiteering, There hasn't been any, I mean, really, I don't think there is a laser focus on that, and it's really,
So we
because I
don't-
think
we
the
don't do
feds and
competition
Congress can
policy.
support fair wages and still combat inflation if you are fair in combating egregious executive pay, monopolies, and corporate profiteering.
We don't do competition policy, and we also don't, broadly speaking, regulate corporate wages.
But
Gentlelady's
956
time's
would have addressed
expired.
it.
Recognized.
Thank you so much, and thank you all for being here. Vice Chair Barr, Silicon Valley Bank, which I feel like no one's focusing more on them as the bad actor here, and the mismanagement and the inappropriate actions. You kept saying over and over again that they weren't responding. If you had, we should have done something when we knew they weren't responding. I mean, what could have been done?
It's an excellent point. I mean, I agree with you. You start with the basic problem that the bank managers mismanaged the bank.
Did they hide something from us? What did they hid all this from us? Do you believe they hid this intentionally from the feds?
I don't have access yet to the full supervisory record.
Will
to
you
be
let
able to
us know?
answer
Because
your
I really
question.
do think they misled and probably lied and made some inappropriate and fraudulent probably actions that I hope that we'll hold them accountable to.
We will definitely be looking into that, and we retain enforcement authority to go after people who, at the bank, who violated the law or who breached their fiduciary duty or who engaged in unsafe and unsound practices, and we will hold them
Yeah,
accountable
and
to the
Chairman
full
Krueger,
extent.
let's not negotiate with bad actors like that. We think this is the time to really hold them accountable, honestly. This is how we set a precedent. But going back to you, Vice Chair Barr, bonuses were paid out when? When was the last bonus paid out before they?
As I said, I'm still getting access to the supervisory
We know it was a
record.
couple hours before, correct?
I've heard news reports about that, but I want to make
So
sure
you don't
that
even
I
know
get
when the
full-
bonuses were paid out? You don't have that information for this committee right now?
I do not have that information
Was
right
it the
now.
day of?
I would like to respond to you fully and accurately, and I want to be careful to do that properly. I've heard news reports about the timing, but I
How
don't have
come
the
the
full...
news knows, but we don't?
Pardon me?
How come the media and the news know, but we don't? How do you not know this before our financial service? Because this is important.
I agree with... I share your outrage about it. I just want to make sure we get to the facts.
Do you even know how much the bonuses were?
As I said, I think you're hitting at exactly the right issues. We're going to use our enforcement authority to the fullest extent possible.
Well, now, everyone's saying, oh, we're going to go ahead and introduce some clawback legislation to see. But, Chairman Gruber, I asked the Fed Chair Powell about this. Section 956, it's been, 12, 13 years? When are we going to have a rulemaking on that? This is about excessive pay. This is about, this is something that Congress already considered. So how come it's over a decade that we don't have anything rulemaking? In 2016, there was a proposal. It wasn't great, but it was a really great start. It would have been instrumental here.
Yeah, no, I'm familiar with the rulemaking, Congresswoman. I was strongly supportive of it. We didn't complete it in time.
Why?
Well, I think there was a change of administrations, and that may have had something to do with it. Every reason to come back to it now and complete that rulemaking, and I
If
think
you had it today, what could you have done in this instance?
it would have
Because
given us-
I'm tired of us being asked to pass things when I
would
feel
have-
like we already did, but
it would
it's
have
over
given,
12 years that we don't actually have something again that we could have used as a tool.
it would have given us explicit clawback authority on compensation. As I pointed out earlier, we do have, in fact, a legal obligation, the FDIC, to investigate the board and management of failed institutions and hold them accountable for any misconduct that might have occurred.
Yeah, public advocates really believe this could have maybe prevented this.
And so we'll
Primarily because, as you guys know, that there's some inappropriate decisions made up so they can do the bonuses
and that's
and the payouts.
and that's what we're
It
going
is
to.
clear as day, and I don't know why my colleagues are not even talking about that.
as
They're
I've-
talking about you all not getting things that, well, they didn't respond. How come nobody's mad at the bank for not responding?
All I can tell you, we've initiated the investigations to get the facts, to take action in regard,
Chairman-
assuming the facts support
Chairman
the
Grunberg,
allegation.
please, for the American people, we need a rulemaking decision on Section 956. You know how critically important this is.
Understood.
This is what, I think it was, I read somewhere, this is the 563rd bank to fail since 2001. There are going to be more. And I know you guys don't want to talk about it, but there will be, because they'll mislead us, they'll lie, they'll do anything for the payouts. I mean, even the risk, what's that risk manager person? What did she give herself? What was it? This is a crazy amount of money she walked out with. I mean, it's crazy. And then Gary Becker, the CEO, sold February 27th, $3 million worth of stock, netting $2.2 million. And he knew this was going to be where we land. And we're not angry about that. We're angry because you guys didn't notice. Well, what about the fact they don't respond? They don't respond to inquiries and things. I mean,
The
that to
gentleman's
me
time has
is,
expired. The gentleman from Pennsylvania, Mr. Muser, is now recognized.
Thank you, Mr. Chairman. We know that
Ms. Tlaib is up for 5 minutes.
Thank you so much, Chairman. Thank you, Director Clements, for this report to really kind of dig deeper into this. I think I get a lot of questions regarding the lack of transparency of fully understanding this. Did you look at the timeline of some of the compensation and payouts and things like that that led up to the failure?
We haven't got to that. We do know that again
Is that
was,
something that you would look into?
it's one of the requests that's in the letter that we received from the chair and ranking member Waters.
That would be wonderful. You know, one of the things my good colleague was talking about is regarding regulators, and you said it's not binding. I mean, could they, because they haven't, when was the first time they said, yo, something's going on? The regulators are like, you know, could you call us back? Can you respond? Or something's going on. What year was that?
The first instance that FSOC brought up the interest rate risk was its most recent annual report, which would have come out early this year.
And so they sent a letter, they tell them whatever. I mean, can they go arrest them? Can they fine them? What can they do to make them respond?
The recommendations in the annual report are non-binding. It can also do what are called Section 120 recommendations, but again, those are also non-binding.
So when you do look at the timeline, because I don't know if you can answer to this question, like why did the banks take on the risks and ignore repeated warnings? Why? Why ignore the federal government and their warnings?
Yeah, I don't have a good answer to
Well,
that.
I think bankers know how to manage risks. They're not stupid. I just think they're greedy. And so, you know, senior employees promoted unsound practices, ignored risks because they stood to benefit from it. Look at the timeline, Director, when you do this next follow-up report. SVB offered some of the most generous compensation packages around. Look at it. Compare it to other banks. In 2022, the CEO, Greg Becker's salary is roughly $1 million, but he enjoyed over $5 million in stock awards last year and $2 million in stock options. Becker also earned over $6 million since 2020 from an incentive compensation plan on SVB's net income, even when the warnings were coming in. This helps explain to me why during 2022, SVB terminated close to $15 billion in interest rate swaps that hedge against the impact of rising rates. The same bank started in 2023 almost completely unhedged because for senior employees, higher net income meant higher compensation, correct?
I'm not familiar with their arrangements. Again, that'd be something we can look at.
You need to look at how the timeline is critically important because you can see how it led up, but they still got benefits. They still won, even though, again, this is impacting now other banks and really people to payroll, small businesses, and so forth. Last year, you know, the Signature Bank CEO, Joe, is it DiPaolo, is that how you say it, received over $8 million in total compensation, Director Clements. I mean, Mr. Clements, do you think that compensation incentives contributed to the poor risk management by the banks?
I don't have a basis at this point.
I know
to
you
say
can't.
that.
I just really love to ask that question. I think in the report, you know, one of the things in Dodd-Frank, and it's something that, you know, our committee has been wonderfully educating me on, but the Section 956, it's been, 12 years, they haven't implemented it. Can you, as in your role, Director, look at the impact of not implementing the Section 956 of the Dodd-Frank Act?
We can certainly take a look at those.
Yeah,
issues.
I mean, this is really important because we need teeth. We need enforcement. We need to be able to claw back. We need to be able to, again, hold them accountable because they're just not going to respond. There's nothing we can do. I mean, they're just going to ignore us so they can set it up so they can benefit from it over and over again. One of the things that I think, American people do fully understand is we as a role of oversight is that we can call it out and do some, basically expose the greed. But unless we give the authority and kind of the force and the binding force for our regulators to do something about it when folks unrespond, other banks are going to do the same. They're just not going to respond to us. They're just going to continue doing this, kind of really crooked, very criminal-like actually, set up so they can benefit and get more compensation. My God, they sold the stock when they knew it was false. I mean, they knew and never informed it. To pick up the phone and tell us, hey, yo, sorry, tomorrow we're closing shop? Ta-da. Why isn't anybody more mad at the banks? They literally just ignored the American people when they ignored the regulators. Thank you, I yield.
Gentlelady's time has expired. The gentleman from Pennsylvania, Mr. Muser, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr.
Can get you a written answer on that. With that, excuse me, the gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you, Mr. Chair. Superintendent Harris, do you think what happened with Silicon Valley Bank led to the other failures?
Yes, I do.
Why?
I think it was a contagion effect between social media, the speed of being able to withdraw, the association, however valid, between some of the banks led to a contagion effect.
So, Director Harris, Becker was here. Did you both listen to the testimony before?
I did.
You did?
In part, yes.
Yeah, Director Harris, Superintendent Harris, one of the things interesting is Becker kept talking about social media. I can understand the other two banks, right? But he kept emphasizing that was a major factor in some of the mismanagement. And somehow, poof, it's because social media, and that's why they were in there. I'm going to get to you, Commissioner. I know, I see you. But do you believe, how much of that really was weight? I can ask the Commissioner, but he basically is leaning on this claim that social media was the reason.
I
even though he
think
got all this
failure of bank management to have adequate liquidity risk management is really at fault.
Yeah. So Commissioner, thank you so much for being here. I know you're getting a lot of, but I think Silicon Valley Bank exposed a lot of, areas for us as members of Congress to work on. I don't know if you listen to the testimony of Becker, the former CEO beforehand, did you?
I did not listen. I heard about some portions of it.
Sure. Do you, one of the things that I kept hearing about, because I know if I'm getting do you send it via email? How do you guys send the correspondence to Silicon Valley? Was the subject matter like matters requiring attention in the subject matter? I'm being serious, like what was being sent to them? Email,
They received 7 supervisory letters detailing their deficiencies. There was 31 MRAs and MIRAs, matters requiring immediate attention. So they were on notice as to their deficiencies.
So I would love to send you, I think the committee should send her a transcript of the whole testimony because, I went through this timeline, as you can see, and I think in January, they started changing their trading plan. Is that what they call it, trading plan? Were you aware of that when in January that they started to implement what they call trading plan change? Were you aware of that, Commissioner?
We became aware from the state perspective afterwards, and we highlighted the risk.
So January 26th, they do that. They implement a change to the corporate trading plan. If you listen to testimony, he says it's completely unrelated. It's like, oops, we failed, but this is after the bonuses, after compensation, which they claim was really already set and scheduled beforehand. Do you believe that?
The matter is under investigation right now, and I think it will come to light soon.
Well, okay. Well, you're going to investigate the role of compensation incentives in your report, ma'am?
We have other programs under DFPI, and I can't confirm or deny other investigations that are ongoing.
Okay. Do you think the incentive compensation plans have contributed to the poor risk management and sufficient response to warnings demonstrated by senior employees at Silicon Valley Bank?
I do think it did contribute. I think there was more of a focus on earnings and gain than there was on risk management.
Yeah, I mean, through the chair, I really think there should be an investigation in whether or not Mr. Becker was fully truthful with us as members of Congress in this committee. It was very telling of how little he claimed to know and that others knew, and that this was just by coincidence, that this timeline, if you look at it, any layperson could look at this and see this was set up in a way, again, for him to make millions and everybody to walk away while our financial system in our country is basically hurt and harmed, as we can see with the two other banks that failed. I know there's nothing they can do, but I really would love for you all to respond directly to some of the testimony by Becker. I think it's very telling how little he claims to know, and I really don't believe he didn't know all of what was going down.
Gentlelady's time has expired. The gentleman from Florida, Mr. Donalds, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Harris, Ms. Hewlett, thanks so much.
The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you so much, Chairman. I'm really incredibly taken aback. I always look at the witnesses that come before us and try to figure out, what lens you're bringing or your lived experience or the people that you serve. And when I found out, and again, these numbers are pretty old, but in 2018, I mean, just look at the witnesses. 2018, ExxonMobil gave American Enterprise Institute $160,000, bringing the total to 4.65. No, keep shaking your head. I want to know why we're here. Because in Detroit, we had the hottest days. Do you know anything about cities like Detroit, New York, Chicago, where working class people are literally suffering because we do nothing about climate? Nothing. We don't give them the resources we pull aside. Why? Because certain industry want to be denied that we even have climate risks and how that impacts people's retirement, how it impacts our economy. It's going to happen. And guess what? You're going to come right back here to want us to bail you out again. Literally. Look at the National Flood Insurance Program. I talk to our chairman all the time. First of all, it is a form of socialism, but okay. That doesn't exist, because those are the big mansions on the ocean, and those folks get bailed out. But my folks, literally their basements, everything get flooded. They're literally suffering every single day. This whole ESG, quote, unquote, whatever debate, it is fabricated political issue. We already know. I mean, luckily there are folks within your industry who have actually spoken up and said, this is BS. That particularly the fossil fuel industry, in some cases, are trying to protect, their short-term profits at the expense of workers, retirees, and communities. Shake your head, but $4.65 million since 2008, this is since 1998, is a lot of freaking money, and that's only just the recent amount of money, and I don't even know what everybody else is taking. But, A.G. Ellison, one of the things that I'm, concerned about, and again, pensioners, families saving for retirement are concerned about the performance of companies over the decades. They really are. They sincerely are. They actually don't trust them. I got a lot of retirees that don't trust them, y'all. I mean, they're pretty, so for them, transparency is a wonder. This is exactly what they need to be talking about. This is exactly what they need. They want to be able to access that information. They need to protect their investments. So A.G. Ellison, can you touch on the ways that ESG disclosures promote long-term value creation instead of risky or short-term profit-seeking initiatives and movements that they're supporting?
Congresswoman, I think they drive a conversation that is essential. I think they drive a dialogue. They allow questions to be asked and answered. I agree. Immaterial, truly immaterial information, that's one thing. But how climate is impacting people in an urban environment like Detroit, where I grew up, it's everything. People die when it gets too hot for too long. But also the issue of governance is critical. People want to know, are we getting all points of view in this conversation so that we can assess the risk all the way on a 360 level? And certainly, in the area of social does matter to folks. It certainly is an important thing. It's not a mandate, but it is a critical set of considerations, which I think improve shareholder value. The risk adjustment is more accurate, I think.
You know, it is the anti-ESG crusaders here are simply, you know, for me, carrying the water of corporations that don't really want to disclose long-term risks that their businesses face. And it's true, I don't know how much data we need, how much more studies. I know my folks are really tired of the studies and constantly, you know, because it reveals everything we're supposed to know, right? But we do nothing about it. We're saying not now, not really. And I don't think that there is any care of whether or not the heat or the climate challenges are really impacting human life or certain sectors of the business. And you know, I know, AG Ellison, you're going to give me some examples of material risks related to workplace safety, racial equity, workers' freedom of association that ESG disclosures might reveal. We can continue talking about that. But for me, you know, you lose credibility, like the Manhattan Institute for 2 decades, taking money from Exxon Oil. You lose credibility when you're taking literally money from the people that don't think climate, the challenges are actually here, that we actually have a climate crisis. You lose credibility. You gotta come here and you gotta understand this is real and it's happening, and saying it's not happening or how somehow it's impacting the private sector and stuff. Guess what? You're all gonna end up right here asking us to bail you out. So do something now about it. Don't wait. Don't try to gaslight the American people that ESG is not important.
Gentlelady's time is
For 5 minutes.
Thank you so much. Director, thank you for being here. Your agency, I would call it organization, you're the only, financial regulator that is laser focused on consumer protection, correct?
That's right.
You were created, why? Because there was all these bad actors, they were out of control. We had to do something about it because people were calling us. It wasn't just mortgage fraud, it was so many other things. Is that correct?
And it was a global financial crisis caused by that.
That's right. I read somewhere that CFPB enjoys overwhelming bipartisan support outside of Congress. Something like 75% of Republicans actually support the work that the Consumer Financial Protection Bureau supports. I think it's because you did about $17 billion in relief for over 200 million consumers through the Bureau's enforcement and supervisor activities. And that's why I don't think I'm surprised by those statistics. I actually wanted to look it up because I know I've referred constituents to the Bureau and they've been very incredibly helpful, especially because I think you guys actually read those, you know, the small print of things that get sent out to our consumers. Our residents just don't know what their rights are. I want to talk about the credit card fees because ever since you told me what you are doing on that, I've been bragging about it because I think it's so important to show that the federal government's got your back, that there's this agency that we're independently funding that's specifically working on this. I think you all are, you know, the proposed rule on Regulation Z would likely save cardholders billions of dollars each year. I read something around, roughly $12 billion annually?
That's right.
Director Chopra, when I read that, what is it, like some credit card, it's like part of their business plan that 40% of their profit or something crazy, I don't know, you got to correct me, is from late fees. Like they literally have built a profit and like a line that is specifically all about generating profit from late fees. Can you talk about that?
Well, I just think what Congress wanted when passing that law over a decade ago is just some common sense safeguards that the credit card industry can charge interest, can charge fees, make a profit. But when it's designed to build a business on penalties, lenders should want their customers to pay back and pay on time. We don't want a system where people are happy when someone doesn't pay on time, or if they missed it by a day, I've got them. All we're looking for is something balanced and reasonable.
You know, I looked and it really does impact some of our working poor communities regarding the late fees. You know, they're paying like twice as much than any other cardholders. I also have been incredibly thankful for, and again, the Bureau didn't have to do this, but your report on medical debt literally triggered the credit reporting agency, all the three major ones, to do something. Can you talk, I mean, the fact that you all did this study that basically said, this is the impact of having medical debt on people's consumer report, and it was pretty drastic. I mean, I think I saw something like $88 billion in medical debt are in consumer credit records, which impacts housing, employment, you name it. The credit score and report is used for so many things, including auto insurance rates, as we talked about. Can you talk about that study and what happened? I think days after you all released that study, what happened?
Yeah, shortly after, the three credit reporting conglomerates agreed to really drastically limit what is showing up. They also delayed when it would show up, because often the consumer is just sort of debating and dealing between the insurance company, the provider, the facility. I just think we want to make sure that that credit report is not a place that you can threaten someone to pay something that they don't owe. But we still have to make sure we look at accuracy standards across the board. I also hear there's other types of bills that show up that may not be actually accurate.
Yeah, that's the thing in the report I read. Something around over the last decade or so, maybe from 2005 to now, that there has been a 31% increase in inaccuracy of medical debt, because basically people are being misbilled and all this stuff, and that this is happening. Do you support prohibiting and banning medical debt on people's credit reports?
I think we're going to be proposing some more safeguards on it. It's interesting, medical debt is ill-defined, because it's also medical credit cards. Also, medical debt can show up in other types of debt. So we're trying to work on the specifics.
Yeah, Director, before me, I was shocked to know the VA, our VA sends medical debt of our veterans to credit reporting agents. Did you know the collection agencies?
Yes, though they have dramatically made some changes.
I know, but it's very, very disturbing. Thank you, I yield.
5 minutes.
Thank you so much, Chairman. This is, I think, our third hearing on this. It's bizarre to me because, one of the things that I've been really appreciative of previous administrations and others been talking about, movement around, weatherization and, even manufactured homes doing the kind of upfront, and it does cost money up front, but it leads to reducing, reliance, high utility bills, energy efficiency leads to actually lower bills for many of the families, and they can't afford it. So it's not all going, right out the window when we don't have some of those investments at the front end. So it's really bizarre for me, and we continue to hear this as, oh, the whole housing crisis is because of this. I'm taken aback because we all know it existed before even the ESG even was invented or created. And so, I know in my district, for instance, the tax foreclosure crisis was just unbelievable. We had one of the worst tax foreclosure crises in the country. These are families that actually own their homes, but they could not pay for their property taxes. ESG had nothing to do with it, nothing. Actually, probably if it did, maybe there would have been some sort of best practices or policies implemented. But they're also acting like ESG is like binding. Is ESG binding? Ms. Nagy?
It really depends on whether by law it is.
Yeah, they
otherwise it's a
decide.
standard, yeah.
Is it binding?
It depends on the legislation and possible litigation.
I know, but right now, ESG policies, is it binding? Is it forcing people to, is it binding?
It's not.
It's advisory, right? It's like you should look into this.
It's a factor that can be looked at because it may have correlation with risk magnitude, and it's consistent with fiduciary duty in the investment community.
Sure. How about you, ma'am?
Codes requirements are binding, yes, ma'am.
Oh, they're binding. They're requiring them to look at these things because because it's actually increasing their mortgage payments? Is it increasing the cost of home? I mean, I don't understand.
The 2021 Energy Code would increase the cost of a home. About, I think some of our members say about $31,000 in their area.
So one of the things that my colleagues talk about is manufactured homes, and it's about 11%, I think. Is it 11%, Mr. Bird? Like 11% of single-family homes are manufactured housing, is that correct?
Yeah, from that to the mid-teens.
Yeah. So one of the things that they were trying to advance is energy-efficient standards for manufactured homes, which many have claimed have made them unaffordable. But though the data and everyone shows that the cost to comply with energy standards, actually those improvements reduce maintenance utility costs for manufacturing housing residents in the long term. Is that correct?
That's not correct.
Really? Why is that?
well,
You
there-
tell
there-
me, because you're all acting like this environmental, this whole little policies around looking at the fact that we have a climate crisis is increasing the cost of manufactured homes, which we all know is because of private equity firms, because of investors. Ms. Nagy, you know I'm right. All this existed before that. And now that we're telling them, hey, you got to be more responsible, that all of a sudden we're saying, no. You're the reason that we got to increase costs on these folks.
Private equity firms aren't generally involved in the manufacturing.
I'm just telling you, this is overgeneral because it's only 11% of your
just
business.
allow
You're saying right now that's not the reason that manufactured homes are rising costs. You're saying it's ESG.
I'm saying it's a contributor, and it is binding.
It's a contributor?
It is.
When did ESG come up in the manufactured homes industry? When?
ESG is a
When?
framework. It's the
When?
mandates.
When did it come about? When did they start talking about? 2019? 18?
We're facing these DOE.
When did they start talking about ESG in your industry? No, I really mean it, you guys, because understand this. This is the bizarre thing. I've never even heard of ESG until now. Like I'm really curious because to me, my families, they've seen the rising cost of housing, not because of ESG. It's because of all the other issues I wish we would be more targeted around talking about. Because majority of the homes in my district are less than $100,000. But we can't get some of these banks to actually loan because it's not profitable. So somebody that wants to buy a $60,000, $70,000 home in Wayne County, Michigan, can't find somebody to lend it to them because it's not profitable. So what do they, literally everybody else is swallowing up these homes because, 60, 70 investor firms come together, they buy a bunch of them, they turn them into rental properties. Where literally I have a block and like 2 people own their homes, the rest of them are literally renters. And they're paying way more, much more, than what they would have paid if they had gotten a mortgage from some sort of banking industry. I say this, and I really don't want you all to say, I'm not disrespecting you all, but please don't make this about ESG. You're actually failing your members in your industry and literally your sector by focusing on ESG and not the root causes of why the cost of housing is going up in our country. Mr. Speaker, credit and consumer reports, which often contain errors, are increasingly an obstacle for many of our residents from meeting their basic needs. Victims of financial abuse and fraud, or those strapped with medical debt, are regularly denied access to employment, housing, transportation because of their credit history. Our neighbors should not have to go without basic necessities because they fell victim to fraudulent activity or predatory lenders. Survivors of domestic abuse, for instance, do not deserve to have debt resulting from the abuse of their credit report. Medical debt should not prevent someone from securing shelter or an education. That's why I'm reintroducing the Restoring Unfairly Impaired Credit and Protecting Consumers Act to provide credit restoration for victims of predatory lending, fraud, and other financial abuse, prohibiting the reporting of medical debt, reduce the length of time that adverse information appears on credit reports from 7 down to 4 years. Know this, economists say 7 years is not a good indicator. So many of the residents, especially in your districts, will tell you reducing it down to 4 years can be transformative for their families. So I urge my colleagues to please support this bill.
Goes back. The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you. Thank you, Chair Kinsler, for being here. I know that you've been pretty public about the fact that, or maybe you made an argument or took a position that it's too costly for firms if the SEC establish a robust climate disclosure rule. Is that correct?
There are many comments in our comment file that have raised that, and that's what I'm talking about, because we, under the Administrative Procedure Act, have to take all those comments and do an economic analysis that takes into consideration the cost.
So in those comments, one of the things is suggested, this is despite, I think, about 1,000 companies have already voluntarily reported emissions from their customers and suppliers. We call it Scope 3 emissions, as you know, where most of the firm's greenhouse gas emissions can originate. So on top of that, we also are now seeing thousands of additional U.S. companies will soon be required to report Scope 3 emissions to comply with the EU standards. And then California, I think, just passed a bill that would require roughly 5,000 public and private companies to report Scope 3 emissions, correct?
Yes, I believe both Europe and if the governor signs the law in California,
Sure.
that will be the case. And it will change the economics because it, in essence, changes the baseline.
So do you think you're going to look at that? And because those three, just looking at those moves by California, of course, and the EU, Scope 3 emissions disclosures, would it undermine, I think, the argument that such reporting would be overly burdensome to be required by SEC?
While it may change the economics over the course of the years, California's rule wouldn't be in place till 2027, I believe. It's still, we, the SEC, have to stay within our remit and the laws as Congress has passed, and it's about investor decisions and what they're being disclosed.
Sure. So if I may, Chair, I would like to submit for the record a letter signed by 25 of my colleagues, House and Senate, urging you, Chair Gensler, to finalize a robust climate disclosure rule that includes Scope 3 emissions.
Without objection.
It's pretty simple why we need a robust disclosure rule, Chair. I mean, it's simple maybe for me. I know this is what you do every day, but I think the impact on the ground for my families is pretty clear. I mean, currently U.S. companies can and do obscure their exposure to climate risks, as you probably already know, and threaten the investments that retirees and workers depend on. So for example, like you look at Brookfield Renewable, an affiliate of a giant asset manager, and Brookfield describes itself as, this is quote, one of the world's largest publicly traded pure play renewable power platforms. Sounds like a choice that would avoid climate-related financial risks, right? Wrong. A recent report found that Brookfield Renewable is invested in a fund that holds fossil fuel infrastructure assets, including Alberta oil sands pipelines, which the firm does not disclose in its SEC filings. This is just one example among many, Chair, of financial greenwashing, which regularly involves omission of Scope 3 emissions. So again, I really think such practices jeopardize the hard-earned life savings of many of my residents and workers across our country, retirees that invested paycheck after paycheck, year after year, to secure their financial future. So just please know, and I want to be on record, that I really would urge you to move forward on having a robust disclosure firm. But with that, Mr. Chair, I would like to yield the rest of my time to Member Foster.
Minutes. Recognize the microphones are terrible and the acoustics are terrible. Thanks so much. And you're now recognized.
Thank you, Mr. Chair. Thank you to my colleagues for this opportunity to talk about the impact of a number of policies on my constituents. Today, I want to talk about two issues affecting our residents: medical debt as a factor in credit reports and auto insurance discrimination. Roughly 20%, Mr. Chair, of Americans have medical debt, and it's a tremendous amount of burden. In addition to regularly forcing families to exhaust their savings or cut back on food or clothing, such debt also prevents, and this is the key issue, our residents from meeting their basic needs by marrying their access to credit, meaning access to home ownership. A different number of issues, again, treating medical debt as if they purchased a car and not actually sought health services. I believe this is wrong. Undergoing, Mr. Chair, a medical procedure should never haunt someone financially. No one chooses to be sick. To make matters worse, medical debt has questionable predictive value. It is not necessary to use medical debt to predict a borrower's future credit risk. Furthermore, debt collectors often rely on inaccurate information, as many of our residents have told us, also pressuring those recovering from illnesses to pay bills they might not even owe. The issue also hits particularly hard in communities like mine, where residents already face challenges with access to credit and have long advocated on behalf of those saddled with medical debt. For instance, my Restoring Unfairly Impaired Credit and Protecting Consumers Act would prohibit outright the reporting of medical debt on consumer reports among those provisions to protect consumers. A medical emergency should not and need not send a family into financial ruin. I've seen it with my families who literally have a loved one with cancer and so forth, literally go bankrupt, preventing them, again, from truly being able to thrive in our country. I urge my colleagues to please join me in ensuring that no family has to face such difficulties by please supporting this bill and bringing it before this committee for consideration. The next issue I would like to now discuss is about auto insurance discrimination. Auto insurance discrimination is keeping my residents in a cycle of poverty. it's really important for folks to know marital status, credit score, all of those things should not be factors in whether or not somebody's a good driver. And right now, this has been impacting folks in order to take like a new job or go to school or deal with a medical emergency. One needs to access reliable transportation. And for many of my residents in my district, it's access to a car. Yet Michigan has one of the most expensive car insurance in the nation. So it is outrageous for me that my residents get asked whether or not they're married, what kind of education level they have, their credit score, all of it is really incredibly hurtful in being put towards the auto insurance rates. This summer, I know Michigan residents saw a 42% fee increase by the Consumer Michigan Catastrophic Claims Association, adding to high fees that are already unaffordable for many of our families. I know when I saw the University of Michigan report showing somebody with a DUI drinking under the influence, but he had a lower credit score compared to someone with a very, decent credit score, but not as high, but he had no DUI. The person that had the DUI drinking under the influence was paying 3 times higher in auto insurance rates than the person that did not have any violation. So we must stop using these non-driving factors in auto insurance rates. So again, I'm really grateful for my amazing partner in this is Congresswoman Bonnie Watson-Coleman. We have the Prohibit Auto Insurance Discrimination Act, which would prohibit the use of these proxies like education and zip codes to calculate insurance rates. Again, thank you so much for this opportunity to uplift my residents and some of the struggles that they have, and hopefully colleagues would work with me on Financial Services Committee on these issues.
Thank you. Thank you for testimony on important policy matters, and I thank you for making it here for Member Day, and you're the final testimony of the day. I'll yield to the ranking member.
Thank you very much. Ms. Tlaib, I want to thank you for your strong leadership in highlighting all the problems with medical debt. And I'd like to just get a little advice from you here. Of course, we know how it unfairly tarnishes so many consumers' credit scores the way the information gets reported by the major credit bureaus. There's no research that shows medical debt is a good indicator of an individual's credit worthiness. If you get sick and need medical care, that should not affect your ability to take out a loan, renting an apartment, or even getting a job. But that's exactly what has happened, given the way our broken credit reporting system works. After working on this issue myself for more than a decade, I was pleased the National Credit Bureaus have taken steps to remove some medical debt information from consumers' credit reports. However, much more needs to be done, and I'm pleased that CFPB Director Chopra is taking further steps to address this issue. Mr. Lee, we have not held any hearings in our committee this year exploring this issue in any depth. Do you believe that the committee should hold a hearing with the CEOs of the National Credit Bureaus and experts on these issues, and then look to mark up your bill and others put forward by members of our committee to fix our broken credit reporting system? What do you think?
Yes, and Ranking Member, as you know, we did actually have the 3 largest credit reporting agencies before our committee, and many of us were able to ask some of the tough questions that many of my residents are asking, which is even, paid debt. I know the chair and I talked about medical debt and his personal experiences of something getting, paid, but it's still showing up on people's credit report. I think folks don't realize how incredibly important it is to fix credit reporting. It's literally the access to economic opportunities. So even if you're doing so well but you get sick, again, it gets on your credit report. It impacts literally whether or not you're able to thrive later, or whether or not you even can get a loan for a car. People are now looking at credit reports, Ranking Member, for employment. They're looking at it for, folks look to it as some sort of factor in whether or not that this person should be, getting a loan or for housing or whatever. But again, medical debt, to me, it's not like somebody's like, hey, I'm just going to go and rank up medical debt. They're sick. And sometimes it's actually, the majority of the time, when you hear folks talk about filing for bankruptcy in our country, a big, huge factor is medical debt. It's somebody in their family or themselves getting, very sick. And again, cancer is one that I hear consistently in my district. Folks that have to pay an exorbitant amount of money because their insurance doesn't cover fully, because they're underinsured or not covered as much. It is the prescription drugs that continue to pile on my residents. And again, they may not have to pay the full amount, but all of it adds up, especially when it takes months and sometimes years to recover from a serious illness.
Thank you so very much. And your being here today certainly helps put more focus on the issue. And I certainly will work with the chairman to see what we can do in terms of the hearings that you're suggesting. Thank you very much.